Hi guys, do you get confused into positively geared, negatively geared, and positive cash flow properties? If you want to change your confusion to clarification, stay with me. Hi guys, this is John. I'm the founder and director of Admire Property Group, and thank you very much for joining me for another video on my channel. In this channel, I talk about financial literacy, financial independence, passive income, and real estate. If you're new to this channel, make sure you subscribe by clicking on the button below and like it. In this video, I'll help you in differentiating between positively geared, negatively geared, and positive cash flow properties. And you can get clarification on that and can make better decision if you wanna invest into the real estate in future. Capital growth for the properties I've already covered in my previous video. Just click on the link above if you want to watch that video. And for the cash flow, we will be covering today. So I'll be discussing about the terms like depreciation, LVR, gross yield, cash flow, gearing. If you already know about these terms, you can move on to the next part. But if you want to learn about these terms, keep watching. Coming to the depreciation. Depreciation refers to the decrease in the value of the property because of the wear and tear over the time and because of the decreasing usefulness of the items into the property. Depreciation falls into two main categories. The first one is capital works allowance, and the second one is plant and equipment depreciation. Capital work allowance is also known as Division 43. Division 43 covers the items which are not removable from the property. For example, walls, ceiling. It basically covers the structure of the building. You can claim these items over the period of 40 years or sometimes in 25 years. And plant and equipment depreciation, which is also known as Division 40, covers the items which are removable. For example, blinds, carpets, any other removable appliances like gas, oven, cooktop, like that. All the items in this category have their own effective life depending upon the rules set by the taxation office. I will show you an example of the depreciation schedule, which you can get ready from the quantity surveyor in my video with an example. The next term is LVR, loan to value ratio, and sometimes people call it LTV, loan to value ratio. The loan to value ratio is calculated as like how much loan are you getting to buy a rental property. For example, if you want to buy a rental property of $500,000 and you are getting money from the bank as a leverage of $400,000, then LVR comes out to be $400,000 divided by 500,000, which comes out to be 80%. So the 80% is the LVR ratio for your rental property in this case. So $100,000 is the deposit which you have put in towards the property from your pocket. So the more that deposit you put into the property, the lower the LVR ratio would be. For example, if you put 150,000 instead of $100,000, the LVR ratio comes out to be 70%. So in case of refinancing, for example, if you bought the property 10 years before and you want to refinance it now, then what they do, like they calculate it as like where the amount which you're borrowing from the bank and the value of the property in the current time. And in most of the cases, what investors do, like they reevaluate their property every year. And if the value of the property has gone up, they try to keep their LVR ratio 80% and 90%. And whatever the increase of the value they have got because of the market growth, they take that money out of the equity and use it for their next investment. So if you take this example, if the value of the property increases from $500,000 to $600,000 and keeping the LVR ratio same as 80%, the value comes out to be $480,000, which bank can lend you. So there is a difference of $80,000. So what the investor can do is out of $80,000, he can take some equity out or to invest in his next property. The next term is gross yield. So gross yield is the ratio of the annual rental income from the rental property divided by the value of the property. So it is used to calculate the potential return on the investment which you invest in buying that rental property. The next term which we want to discuss is cash flow. So cash flow refers to the amount of money generated from the rental property after all the expenses have been paid off. It is calculated by minusing the amount of all the expenses like property management, repairs, any startup fees from the rental income generated from the property, that comes out, that is your cash flow. Let's move to our example now. Consider an investor who invests $400,000 to buy a property, and he keeps it as LVR ratio of 80%. So means like $80,000 he pays from his pocket, and rest of the money he gets from the bank as a leverage. And he puts this property into the market for rental income and achieves a rental income of $500 per week. Then the annual return from his rental property would be $26,000. So this is his rental income, annual rental income from his rental property. And please note that I have taken all these figures as an assumption. In this example, I have just taken the baseline figures. So coming to the expenses, the biggest expense which an investor bears is interest expense. The money which he have borrowed from the bank, he pays interest on that. So 6% as the interest rate he's paying. The interest expense comes out to be 19K. And there are some other charges like water rates, council rates, repair charges, property management. I've taken 5.5% management fees in this example. So the total expense for this property comes out to be around 25K. And if we minus all these expenses from the rental income of $26,000, the cash flow pre-tax comes out to be $1,000. So this is the amount which the investor is getting in his pocket in a year, with all the expenses paid off and the rental income which he has generated from the rental property. So the cash flow pre-tax, which is $1,000 in this case, is the amount which the investor is getting in his pocket after minusing all the expenses. If you divide it by 52, it comes out to be roughly $20 per week he's getting into the pocket. Now, in the similar way, there's another investor who has invested the same amount of money onto the rental property with the same LVR ratio, but he is getting a rental income of $400 per week, depending upon the location of the property he has chosen. The total rental income he's getting is $21,000. And coming to the expenses for that property, the total expenses in this case will get reduced because of the reduction in the management charges, because the management charges, as we have taken it as like 5.5% of the rental value. If he's getting less rental, the management charges, all the expenses are same in this case. And if we total all these expenses, these come out to be $25,000 roughly. And if you minus these expenses of $25,000 from a rental income of $21,000, there is a difference of $4,000, which is like cash flow before tax, which is a negative figure. So it means this investor is paying $4,000 out of his pocket every year to manage this property. And per week, he's paying approximately $72 out of his pocket to maintain this property. So in first case, the investor is getting money in his pocket every week. So it is a positively geared property. And in the second case, investor is paying money out of his pocket every week, and it is a negatively geared property. So this is how you decide whether a property is positively geared or negatively geared. Now we will include the depreciation. First of all, I will show you an example of one of my clients' depreciation schedule. If you see this example, the capital work deductions in the year 22-23 is $8,500, and the plant and equipment deductions are total coming out to be $4,500. If an investor buys a newly constructed property, then he can claim $13,000 as deduction. But if it's an existing property, he can claim only the capital part, which is $8,500, and rest of the amount, which is $4,500, go into the capital gains tax calculation if he sells a property in future. So the claim for the depreciation can range from $3,000, $4,000 up to $20,000, $25,000, depending upon the value of the property. Let's consider an example of a depreciation amount of $10,000, which both the investors can claim on their rental property. So if we include the amount of depreciation and assumption of like $10,000 in both the cases, and let's see what is the difference in the figures now. In case of first investor, the cash flow on paper comes out to be $9,000 in negative. And in case of the second investor, it comes out to be approximately $14,000 in negative. So this is cash flow on paper. It means both the investors are losing money on paper. And assuming that both the investors were getting an income of 100K, and before their rental property, they were paying a tax of 25K every year. But with these rental properties, now the investor, and after they have bought these rental properties, both the investors will be paying less. So in case of first investor, he can deduct $9,000 from his 100K income and will pay tax on $91,000. In the same way, the second investor will reduce his income of $100,000 by $14,000, and he will pay tax on $86,000. In this way, the first investor will start saving $3,000, and if we add these $3,000 with his $1,000 positive gearing cash flow, so the total savings he is getting $4,000 every year. And in case of the second investor, he was paying 25K as a tax, and after taking the depreciation of the rental properties into the figure, he will be paying roughly $20,000 as tax. So he will be getting a refund of roughly 4,500 from the tax office. And if he subtracts his cash negative from this tax refund, the net cash flow he gets is $650 every year for his negatively geared property. So this is a positive figure, so it means he is getting a positive cash flow. So this is how a negatively geared property turns into a positive cash flow property when we take the depreciation into the account. So this is where we can decide whether a negatively geared property is negative cash flow or positive cash flow. So in this case, this negatively geared property has become positive cash flow property when we consider the depreciation into the picture. So this is the difference between positively geared property and positive cash flow property. So positively geared property is always a cash flow positive, but negatively geared property could be negatively cash flow property, or it could be a positive cash flow property depending upon how much depreciation you can claim into the tax. And please note, the cash flow after tax for a negatively geared property may be positive or negative depending upon the depreciation you can claim and depending upon the amount you have invested to buy that rental property. And in these examples, we have considered both the investors in the 32.5% tax bracket. And gross yield for this property is calculated as the net rental annual income divided by the purchase price of the property. So in case of first investor, it's coming out to be 6.5%. And in case of the second investor, it's coming out to be 5.2%. The reason it is less in the second case is because of the rental income. Lesser is the rental income, lesser the gross yield will be for the property. So it depends upon the strategies of the investor which he is using, whether he want to go for a positively geared property or a negatively geared property, or he wants to go for a negatively geared property with a positive cash flow. It all depends upon their strategy they want to use it. So this is where we can help you. We can sit together and check what your goals are and what you want to achieve, and then we can work out a strategy for you, whether you should go for a positively geared property or negatively geared property. Some of investors go for positively geared property, and some of them go for the negatively geared property, depending upon like what sort of income they are getting. And most of the times, what we do is depending upon their income resources and their goal, we create a strategy for them where we first will go for the capital growth, which could be a negatively geared property, and then we start working on the positively geared property so that there is a mix of capital growth and capital flow. The investor can increase their wealth with the purchase of every property. And these are the main things which you need to take into the consideration, like rental income, location of the property, interest expense, property management charges. All these things play a big role while buying an investment property and deciding whether it's a positive cash flow property, positive gearing, negative gearing, or a neutral gearing. And a neutral gearing property is when you are not paying anything out of your pocket and you are not getting anything in your pocket after all these expenses from the rental property. So this is how an investor gets two different kinds of income from his investment into the rental properties. The first one is the capital growth, which I have already discussed in my previous video. If you want to watch that video, just click on the link above. and this cash flow which we have discussed today. So both of these incomes you can consider as your passive income because you are not doing any work for these incomes to be generated. And your money into the investment properties is doing the heavy lifting for you. If you keep on investing like this, and you will be getting capital growth and the cash flow, and you can increase your passive income to create wealth for you. I hope you liked the video, friends. If you like it, make sure you click on the like button and subscribe to the channel, and make sure you share it with your friends so that I can keep producing more of these videos. I will catch you in my next video. Thank you. Bye.